Whether you're launching a freight brokerage or tightening up compliance, understanding freight broker bonding and insurance isn't optional, it's essential. This is 𝐒𝐏𝐈 𝐋𝐨𝐧𝐧𝐞𝐜, and in this video, we'll walk through the key bonding and insurance requirements you need to operate legally and protect your freight brokerage. To operate legally as a freight broker in the U.S., the Federal Motor Carrier Safety Administration requires proof of financial responsibility and protection against fraud. That's where bonds and insurance come in. Without them, your brokerage can't be granted authority, and you'll have trouble building trust with carriers and shippers. Let's break down the key components every freight broker must understand. Freight Broker Bond BMC 84. This is a $75,000 surety bond that every broker must have. It protects carriers and shippers if the broker fails to pay or behaves fraudulently. If you don't comply, the bond covers claims made against you, up to that $75,000 threshold. Surety bond versus trust fund. You have two options. The BMC 84 surety bond is a policy you pay an annual premium for. The BMC 85 trust fund requires depositing the full $75,000 into a trust account. Most new brokers choose the bond because it's more affordable up front. Bond premium costs. While the required bond amount is $75,000, you don't pay that out of pocket. Instead, you pay a premium, which typically ranges from $938 to $9,000 per year. Your cost depends on credit score, industry experience, financial history, and any past claims. Getting bonded with bad credit. If you have a lower credit score, some surety providers specialize in helping new brokers get bonded. You might pay a higher premium, but it's still possible to qualify and operate legally. Required insurance coverage. Beyond bonding, most freight brokers also carry general liability insurance to protect your office and operations, contingent cargo insurance in case a shipper's goods are lost or damaged and the carrier's insurance doesn't cover it, errors and omissions insurance to protect against clerical mistakes or data mishandling. Insurance costs. Insurance pricing varies, but on average, general liability might cost $401,000 a year, contingent cargo can range from $500–$200 a year, errors and omissions starts around $300–$500 a year. Bond verification and renewal. You can always verify your bond and FMCSA authority status using the FMCSA licensing and insurance database. Bonds must be renewed annually, and they're now electronically filed with the FMCSA through an approved surety company. If your bond lapses, even for a day, your authority can be revoked. These bonding and insurance requirements aren't just paperwork. They ensure accountability, prevent fraud, and protect carriers and shippers in an industry built on trust. Without them, no freight brokerage can stay in business. Getting bonded and insured isn't just about compliance. It enhances your credibility with partners, reduces your financial risk, helps you qualify for contracts with reputable carriers and shippers. However, many new brokers struggle with the cost of bonding, especially with poor credit. Others get overwhelmed navigating insurance options and renewal timelines. Legacy processes make it easy to miss a deadline, putting your entire operation at risk. That's why current leading brokers use digital compliance platforms to automate bond renewals and MCS 150 filings, get real-time alerts for expiration dates, compare insurance quotes in one place. These tools simplify the paperwork and reduce the risk of operational gaps. That wraps up this episode of 𝐒𝐏𝐈 𝐋𝐨𝐧𝐧𝐞𝐜. If you're launching or scaling your brokerage, make sure you're subscribed for more practical tips on compliance, operations, and growth strategies.